Welcome, everyone, and we're delighted to have with us today for this insightful webinar on understanding equity-linked saving schemes, or the ELSS, with Canara Robeco AMC. So to guide us through this session, we have our esteemed speaker, Mr. Vishal Mishra, who brings us a wealth of knowledge, experience in the equity markets and fund management. So about our speaker, Mr. Vishal Mishra is a fund manager equities at Canara Robeco Asset Management Company, where he plays a crucial role in managing, strategizing equity investments. With his deep understanding of market trends and investment strategies, he has been instrumental in delivering consistent performance and value to investors. So today he's going to walk us through the benefits of ELSS, how it helps us in tax planning, and why does Canara Robeco ELSS Tax Saver Fund could be a smart choice for investors. So let's get started. Over to you, sir.
Thank you so much, and thank you for hosting me for this webinar. What I'll do is I'll start briefly with a background about the ELSS as a category, and maybe throw some light as to why this category came into existence, why there are certain things that are associated with it in the sense of having a lock-in period or having some tax advantages. And then, of course, we can take questions as they come. In our opinion, what happened is the government had this intention of introducing the retail investors to the equity markets through a relatively safer instrument, and that's where a mutual fund as an option came into existence for to incentivize the investors into investing. What better way to incentivize them by giving them a tax benefit? But of course, it came in with a 3-year lock-in period. So for these specific requirements, a specific mutual fund category had to be created, and that's how the ELSS category came into being. It meets certain specific requirements, at least that was the intention when it was conceptualized, but over a period of time, it has been run quite well by every mutual fund and has become a viable investment option when someone is planning their investments into mutual funds. The good thing about this is that on one hand, you get the tax benefits that come your way, but more importantly, the long-term wealth creation is very much possible through this instrument because of the lock-in period, which ensures that you stay invested in the scheme for at least 3 years, if not more. I cannot hear you. I think you're on mute.
Yeah. Can you hear me now, sir?
Yeah, perfect.
So what, according to you, is ELSS and how does it help in both tax saving and wealth creation?
Right. So the most important thing, like I mentioned, is the 3-year lock-in period. So what happens is investors tend to enter the mutual fund, especially the new investors. They enter the mutual fund industry, buy a few schemes, and when the schemes do reasonably well, they make a little bit of money, or even if they are not making money, the fickleness in the behavior comes into play, and that means that he doesn't hold the investment long enough. What happens with the 3-year lock-in period is that the investor remains invested for a reasonably longer period of time. And the longer you're invested in the equity markets, the less volatile the returns would be, and you're more likely to generate returns which are better than what you would have expected. So that in a way is where the 3-year lock-in comes in, and the wealth creation also happens because of that. And the tax benefits you definitely get through the Section 80C benefits that come through the older scheme, if you're going through the older regime, and that benefit is definitely there for mutual fund investors to take advantage of.
So this actually answers both my first and my second question. So I'm going to go straight to my third. ELSS funds, they invest in equities. So how risky is it compared to a PPF or a fixed deposit?
Sure. So ELSS funds, of course, basically are diversified mutual funds. So they carry the risks and volatility that are associated with investing in equities. So they are definitely more riskier as compared to PPF and FDs, also because there is no guarantee of returns. And in a way, even your capital is at risk because you can have a drop in your NAVs. So that risk is definitely there, and it makes ELSS funds or in fact mutual fund investing definitely a lot more riskier than PPFs and FDs. But there is enough data to suggest while past performances are not an indication of future returns, there is enough data to suggest that if you're invested for the longer term, for at least 3 years and not more, and better if more, the volatility and the noise that is associated with equity investments that comes down, and the returns tend to be a little more secular. So if you're looking at investing from a longer term perspective, which is what ELSS is because of the 3-year lock-in period, I think the risk adjusted returns definitely warrant any investor who's looking at PPFs and FDs to also consider taking a bit more risk and looking at optimizing the portfolio returns for them as a whole. But of course, it is very case to case or very individual or portfolio specific. So it's best to take advice on this before deciding.
And can investing in ELSS through an SIP better than a lump sum? And if yes, why?
Right. I strongly believe that timing the market is something which is very difficult, and for that reason, it's best that unless you are in a situation where the markets have fallen due to any black swan event or very sharply, or there is that could be a case where you can consider lump sum investments. But otherwise, smoothing your investments through SIP over a time period definitely is a much better option to consider.
Okay. So tell us, how does the Canara Robeco ELSS Tax Saver Fund decide which stocks to invest in?
Sure. So at Canara Robeco, we have an investment process which is universal for all schemes. Our investment process requires us to screen the companies on 3 key parameters, which is business, management, and valuations. And only when these 3 criteria are met reasonably to our satisfaction does the company become eligible to be in our universe or be investable. And then based on the fund mandate, the FM's comfort, and the company and market dynamics, the FM will construct portfolios of such stocks and keep rebalancing it as needed and as situations or as more incremental data points come in. And for ELSS, I follow exactly the same process. The process is very universal. Basically focusing on our 3 key parameters of business, the quality of business, the quality of management, whether they have a track record of taking advantage of opportunities that come your way in business, and they also have the track record of at least being fair to minority investors that we tend to be in any company. And valuations should be as reasonable, keeping in mind the business as well as the management. And one important thing that I would like to highlight over here is that the investment process for us is of paramount importance. And we certainly would never deviate from our investment process and thesis, irrespective of the fund performance or the market dynamics or market movement. So we strongly believe that consistency in investment processes is pivotal to fund performance, and hence that is something that is consistent across market cycles for us.
So if you can just tell us how much tax can actually somebody save by investing in ELSS? Huh?
Right. One thing I would like to highlight here is that the audience needs to know that there are 2 tax regimes, the old tax regime and the new tax regime. So there are no tax benefits of investing in an ELSS scheme if you are under the new tax regime or if you choose the new tax regime. But under the old tax regime, under Section 80C, you do get deductions for the amount of investments that you do in ELSS funds to the extent of 1.5 lakh rupees per annum. You just multiply 1.5 lakh rupees by your tax bracket, whichever it would be, and that would be the amount that you could save per annum if this is the only benefit that you're taking under Section 80C as an advantage. But here again, the complications of tax are enough that it's best that you do advise and get a confirmation about your situation before you decide to invest.
So, sir, should investors withdraw their ELSS investment after 3 years, or according to you, it's better to stay invested for longer?
Right. So post the lock-in period, there is this tendency to withdraw, but what I would suggest is that an investor should review his allocation depending on his financial needs. Just because the lock-in period is complete does not mean that the investor should redeem his investments. As you know, there would be tax implications in the form of long-term capital gains tax that would that would apply if you are redeeming after 3 years. So what I would suggest is that the investors can treat this investment after the lock-in period as an allocation to a diversified scheme of any other mutual fund that they hold, and decide his action based on his financial needs at that time, and also keep in mind other factors like his overall exposure to equities and mutual funds based on the risk profile and other factors that come into play.
Yeah. So, sir, just one last question. What's the biggest mistake, according to you, that investors make with ELSS, sir?
Right. So I wouldn't call it a mistake, but there are certainly some misconceptions which are associated with ELSS investing. And the most common misconception is that these funds are to be like, or this scheme has to be looked at only if there is a need to save taxes under the old tax regime. But there are many advantages beyond tax benefits that come with ELSS fund. The lock-in feature of this category is very helpful in actually inculcating disciplined long-term investing, which I must say is not easy for most investors, primarily because there is a lot of noise in the short term, which in a way deter you or distract you from your long-term objectives, and this lock-in period it brings in some discipline in the way you're investing, and that definitely helps in long-term wealth creation. Another misconception, again not a mistake, is that this perception that investors should redeem from such funds once the lock-in period is over. But as we discussed earlier, this involves tax implications, and hence should be done only if the investor needs these funds. Else, like I said, the investment should be evaluated as any other mutual fund investment, and a decision should be taken accordingly.
All right, sir. So if you can just sum up your the Robeco mutual fund right now in a couple of sentences of how you perceive it to be and how it needs to be for the investors coming on board, what would you like to say, sir?
Right. So we are one of the oldest mutual funds in India. We are a joint venture between Canara Bank, which is a 51% stakeholder, and Robeco, which is a Rotterdam-based investment house with more than 100 years of just managing people's money. And if you look at our parentage, you would see that risk-adjusted returns or managing risk is extremely important for us. The culture of being very conservative flows in from our parents, which is Canara Bank as well as Robeco. Our objective is always to look at companies from a growth, from an earnings growth and earnings momentum perspective. What we certainly try to avoid is stock price momentum and playing those. For us, investing is very much fundamental driven through the investment process that I briefly took you through, which is keeping in mind the 3 factors of business, valuations, and management, and focus on risk-adjusted returns. We look at fund management not just as generating absolute returns, but generating returns with as little volatility as is possible. And I think that is the cornerstone with which we have our investment process and also how we construct portfolios. So if the investor is looking at risk-adjusted returns, then definitely Canara Robeco should be an option that should be considered by them.
Okay. Really appreciate this, sir. Thank you for being part of this session. And thank you to everyone who's actually coming on board and looking at our webinar that's actually going to give you completely a lot more insights. So we hope you found today's discussion on ELSS and tax saving strategies insightful and valuable. A huge thank you to you, sir, for sharing your expertise and providing us with a clear understanding of how ELSS can be a powerful tool for tax planning and wealth creation. So the key takeaways from today's session would be like ELSS helps you save taxes under ATC, Section 18C, and a 3-year lock-in promotes a discipline for a long-term investing. And the Canara Robeco ELSS Tax Saver Fund offers a great way to combine tax benefits with equity market growth. So thank you everyone. And please follow us for updates on our upcoming sessions and investments. Thank you again, sir.
Yep. Thank you so much. Thank you for your time.